Welcome to Chit Chat Stocks, the podcast that helps you discover your next great investment. I am your host, Ryan Henderson, and I am joined, as always, by the one and only Brett Schaefer. This is our weekly Power Hour episode. We're on Investment Power Hour number 183. We've been doing this for 3.5 years now, roughly, and people seem to love it. We do these shows live on YouTube on Thursdays at 5 p.m. Eastern Time. If you want to ask us any questions, head on over to YouTube, look up Chit Chat Stocks, and feel free to post in the comments as we are doing these shows. But on these episodes, we talk all things financial markets. Earnings season is back. It's that time of the quarter again. We've got Interactive Brokers, ASML, Taiwan Semiconductor, trying to think of some others that I missed, Charles Schwab, which had an interesting anecdata, I should say, that we should talk about. Might be bubble talk for you. And then we're also going to be doing our 6 favorite growth stocks for today, going through, alternating between Brett and I, and we've got plenty to discuss there. Without further ado, welcome in, Brett. How are you today?
Well, markets are down, so my shorts are working today, which is not a bad feeling after it's been a tough month or so in that category. But I went to a baseball game last night where my team lost by 10 in the playoffs. So feeling a little down about that, but I am very excited about earnings season. I have a little bubble watch for people. And also a little talk on gold, silver, and strategic investments by JP Morgan that I think people will be excited about. If you've seen the charts of gold or silver, I think anyone that has invested in that is quite happy. But first, Ryan, what are we going to talk about? Well, TSMC earnings. I think that feels like a great one to kick off earnings season with.
Yeah, let's do Taiwan Semiconductor, which had some interesting call outs during the conference call. Maybe not call outs might be the wrong word, but it's always funny listening to their conference calls because it moves markets a bit and has huge signal and implications for other businesses. But the management teams are so like, that's not their intention. They're not trying to be promotional, but they'll like casually mention kind of insane statistics. So we'll talk about that, and then maybe we can get into kind of the meat and potatoes with our favorite growth stocks as well. But let's start with Taiwan Semiconductor. In US dollar terms, they grew revenue 41% compared to a year ago, which is pretty astounding given their size and scale and already being sort of the biggest player in the fab market. But $33.1 billion in revenue. They added $3 billion in revenue over the last quarter. Although there's probably some seasonality in that business. So quarter over quarter comparisons aren't always perfect. But as we are moving into a time period where AI infrastructure spending is growing so quickly, I think these sequential and quarter over quarter changes are more important to pay attention to. Anyways, this one surprised me. They grew gross margins from last year, 57.8% to 59.5%. They themselves, at the top end of their guidance range, was like 57% gross margins. Some of that might have been due to currency translations. So that might have helped, because if you look at like their Taiwanese reported revenue growth, it was like 31%, and their US revenue growth was like 40%. So that was probably helpful.
Pricing power, Ryan. If you want to hear some interesting, I think the listeners would like this too. Some interesting facts. ASML operating margin, which is a supplier for TSMC, 35% operating margin. Probably could go higher over the long term since they're investing a lot for growth. So 35% operating margin. If you look at TSMC itself, they have 50% operating margin. And then if you look at NVIDIA, which TSMC is a supplier for, NVIDIA is a customer of TSMC. I believe they have over 50% operating margin. So you have 3 layers in the chain. Maybe we can add an AWS, 35% as well. So 35%, 50%, 50%, 35%. It's quite the lucrative industry. Semiconductors and AI computing and cloud computing.
Yeah, and I think you could argue there's pricing power at every stage there of that chain. Maybe less so on the cloud side, but
Ask me in
between
2028, maybe.
yeah,
2025, there is for sure.
I think for certainly for ASML and Taiwan Semiconductor, but
Yes.
NVIDIA as well at the moment. Anyways, let's keep going here. So 60% of their revenue now comes from their most advanced nodes, so 5 nanometer and lower. That's really the 5 nanometer and the 3 nanometer. But on top of that, I thought this was an interesting stat, and I guess it was probably baked in. People probably already saw it coming, but they're delivering more wafer shipments than they ever have. So not only are they delivering their most advanced node, but they're delivering more of them than they ever have. This is the largest wafer shipment quarter that they've in their history from at least going back 10 years. So this is pricing power, advanced chips, increased capacity or productivity, I should say, and increased capacity. This feels like quite the recipe for success for Taiwan Semiconductor. And I thought this quote from the conference call was interesting. So a quarter ago, they said that they thought they could grow their AI accelerator revenue, which is quickly becoming the biggest part of their business. They thought they could grow it in the mid 40% annual growth rate range between 2024 and 2029. We talked about that here on the show, and it was like, I thought that was insane. Like, first of all, I was thinking, how do you have that much visibility 5 years out? Which maybe they do. Maybe they book a lot of stuff like multiple years out, or they contract it. But the other part that threw me off is that this is already a massive business for them. So mid 40% CAGR is truly astounding. Well, this quarter, someone asked, "Do you still believe that?" And they said, "So far, it looks like we're going to be doing a little bit better than that." So they're like, without saying it, they kind of raised that guidance. And and then on top of it, their non AI end markets, because people forget that semiconductors, if you stripped out AI, is kind of in a recession. Still in a bit of a down cycle. They're saying that they're seeing recovery from their non AI end markets as well. It's funny listening to Taiwan Semiconductor's management team because they're very like matter of fact, not trying to be promotional, not trying to be braggy like you might see with some other companies. But that's sort of how it comes off. They're like, "Yeah, actually, we think we'll grow, more than 40% annually for the next 5 years, and yes, we're already the biggest business in the world or biggest foundry in the world." So, I I don't see aside from the geopolitical risk, which obviously that's the one that everyone kind of points at, I don't see how this doesn't beat the market if they come anywhere near those guidance metrics that they've said.
Yeah, well, it's that's you just said it.
But it's
If
not
they don't
like
come close to that guidance metrics.
this isn't a management team that's like, "Oh, I'm just gonna throw out that guidance to bump the stock or like be as promotional as possible." Like that's never been the culture at
So you
TSMC.
could you and I guess if this happens, we talk about this on pretty much every show, but could you imagine in 4 years the AI accelerator demand falling off a cliff? I mean, it's possible, right?
And falling off a cliff, I don't.
Yeah.
I would be very surprised.
Why? I mean, they're spending I've seen data out there that compared to the telecom bubble, they're spending 4 times as much ahead of revenue as telecom was spending ahead of revenue, and they're doing the same sort of circular deal. So, am I saying that's going to happen? No, but is it possible? Oh, it's 100% possible. On the other hand, this is a fantastic business. We have a comment here. I agree totally with this. I watched ASML, or excuse me, TSMC dominate for years, and I turned my nose up at a PE of 20 a couple of years ago. I'm kind of in the same boat. Probably should have just went fantastic business, 15 times earnings. Just add this one. I mean, it's almost a monopoly at this point.
Yeah, yeah, huge moat, obviously. The I don't know. I would be. I honestly could see AI demand and specifically 5 nanometer, 3 nanometer, and anything below that they iterate on, improve on, innovate on. All those nodes, I could see there being a lot Taiwan Semiconductor, I could see them shipping a lot more volume of those nodes in 4 years.
Sure, yeah, but
I
when you
think
say, "I cannot envision any scenario that this underperforms the market,"
that's
that
I'm not saying that. There
well, I think those words may have
Oh,
listeners can come back
if they hit those
if they
metrics,
hit. Sure, sure, okay, that's a good clarifier.
I
Yeah,
guess I
I
can
agree.
envision a scenario which includes some geopolitical risk, but if they hit those metrics, it's hard to envision a scenario where I mean, that would be them trading at like 5 times earnings or something like that in for the stock to
Possible.
not move. But
Well, we're at 33 times earnings right now.
yeah, I mean, if they compound revenue 40% over the next 4 or 5 years, the earnings multiple is gonna come down pretty quick, I imagine.
Yeah, but not I mean, well, it'll be 10, not 5 if we're
Yeah.
doing some math in our heads here. It's still a great business. Would Would I buy today? No, I don't think so. But kudos to anyone that saw the opportunity 2022, early 2023, and knew that this was a wide moat business, widening moat business, and really has a long runway to grow, even though the industry is cyclical, but sees growing demand over the long term.
Yeah, I will this is one of those. I've been a Taiwan Semiconductor shareholder for I think like 6 months now. I honestly don't even know how it's done, but it's one of those companies, it's just a tracker position.
It's done well.
Has it? It's good.
Yes, it has. Look at the
Uh,
chart. It's like the gold chart.
I know it's such a small position that I don't really notice it in my portfolio. But there's companies that I own where maybe it's just I feel like a share less. I don't. It's hard to describe. I don't feel like talking about it as much because I'm not as knowledgeable of a shareholder as a lot of the other shareholders, I imagine. But it was almost like you read a great article about the company, you read a great write up, and it's like sometimes I just take a little tracker position, which I think is what I did 6 months ago. And I'm trying to kind of get there by reading the conference calls and get a better understanding. And maybe it's not that hard. Maybe it's just they're really good at
Don't overthink.
manufacturing
Yeah,
these things.
these ones don't overthink it. Monopoly. Boom. That's it. That's it. You just got. I feel like the key things is just to understand. You don't want to get caught up in the peak of a cycle, right? Where their trailing earnings ratio is 33, and we're at 50% operating margins. So if they see a little bit of pricing pressure, which could happen if demand growth in AI kind of slows down, you might be buying today at a very expensive multiple. But besides that, I feel like understanding the wide moat nature of the business is it's something it's not too bad if you don't try to go, well, how do I say it? Hedge fund analyst looking at satellite data, trying to understand all the intricacies of the factory and the cost of capital for the Arizona build out. These are things you don't need to worry about. Do you think
It
Buffett
truly
worried about
doesn't
that when
matter.
he bought it?
Yeah. No, it truly doesn't matter. But there's companies, we're going to talk about some of the companies today, I imagine, on our favorite growth stocks. But there's companies where it feels like it's an idea that I found or it's unique. There's not as many shareholders, and I feel like I like talking about it. Whereas with Taiwan Semiconductor, it's like I'm kind of just along for the ride. I don't need to be a vocal shareholder. It doesn't matter.
You're waiting for some other people to yeah, it's one where you can outsource a little bit to some of those sharp analysts out there. Last question on TSMC. Simon asks, given today's earnings, what market cap would you buy TSMC at? I think I wouldn't necessarily frame it as what market cap I would buy, but maybe what multiple of forward earnings I would buy versus like maybe a normalized operating margin for a margin of safety where I th- I would worry that their profit margin will come down when demand normalizes and you don't see pricing power across the industry, especially if that trickles down from Nvidia's insane pricing power that they've had the last few years. So maybe normalized to 40 to 45% operating margin and a 15 to 20 times earnings is where I would buy, and that's maybe greedy, but look, the bull market can tell you things and it can make you think 30 to 35 times earnings is cheap, and it's not, even for a company growing like this. So that's how I look at it. What about you, Ryan?
Yeah, I think forward multiples is always sort of a better way to look at it, especially if you can kind of arrive at your own forward assumptions that are maybe different than the market. But market cap specifically, I wouldn't measure it by. It looks like they're trading at basically a $1.2 trillion market cap. I'm seeing it here in Taiwan dollars, whatever the currency is there, at 37 trillion Taiwanese, so 1.2 roughly USD. If it were more in the low 20s on a forward earnings multiple, I think I'd be interested in adding shares.
Yeah, there's still definitely risk here.
Because there
Okay.
okay, we can talk
Sure.
about real quick, just to end this sort of discussion. The You are right. There is a scenario where AI accelerator demand is lower in 3 or 4 years.
Gotta factor that in. Gotta
But
factor it in.
what happens? You lose some money? I think
Buying
the
opportunity.
I think the upside is a lot higher if they are right. If they do
Yeah, I
compound
I
revenue
agree.
at 40% for the next 4 or 5 years, you're getting probably a 3x, 4x on the stock. Maybe not quite that
We
high,
have
but
we have Tyler in the chat that says low 20s on forward multiple. I agree with that, but I'm normalizing maybe long-term operating margins for margin of safety. And responding to you, Ryan, is that possible? Yes, but I'm the type of investor that I don't want to be betting on things I think are a little uncertain. I would rather have the AI. Like, I'm comfortable not investing in TSMC. My portfolio is fine. I'm pretty much 100% invested, plus more with a couple of shorts out there. And I want to find things where I can wait for TSMC to either benefit from the AI bubble or boom, and then maybe it's not a bubble, and it does fine, and maybe the stock doubles over the next 5 years. I'm okay with not getting exposed to that. But if the bubble pops and the stock goes down 60%, I can buy then, and maybe it stays on the watch list forever. That's okay, and I don't own it. But I'm not too worried about that opportunity cost when I think I have great things in my portfolio. Where if the bubble does pop, TSMC goes down a ton, trades at 10 times trough earnings, something like that. I think that is a much better risk reward than buying today.
yeah, I think that's fair. And Tyler, you are right. It's 24 times forward earnings here. So
Again,
maybe,
normalize those margins a little bit. That's what I'm saying. Maybe that's
yeah,
unfair or fair. That's what I would do.
yeah, maybe I just got to take another look at it because I said low 20s forward multiple without actually knowing what the forward multiple was. So
Yeah, so it sounds
thanks
like
for
you wanna
calling that
buy.
out, Tyler. Let's shift gears though. Are you good to do top 6 growth stocks?
I am. You made the rule here, 20% revenue growth, and I had a hard time finding stuff. I couldn't find 3, actually, there were 3 in my portfolio, but I wanted to add a 4th because 'cause we're doing 6, so in case there's any overlap and you take one of mine. Coupang didn't make the list, 19% year-over-year growth, constant currency, so just missed it. Airbnb, no. I didn't wanna put Interactive Brokers because it's expensive, and we're actually gonna talk earnings later. But, Ryan, I gave away the criteria, but anything else you wanna say before we get started here?
No, I was trying to think of like what the criteria should be for a true growth stock. And I basically just pegged it at, is the top line for the business is revenue growing by more than 20% annually year over year based on the last quarter. And
Yeah.
I don't know if I was surprised, maybe a little disappointed, honestly, when I looked at my portfolio and realized how few companies actually are
No, we
growing
invest
that
in
fast.
future growth stocks. Stuff like,
Sure.
Portillo's, Airbnb, Nintendo, stuff that's gonna accelerate revenue growth, right?
Yeah. And in our
That's the idea.
optimistic scenarios. Yeah, maybe. But I realized I own a ton of companies, pretty much the I think I would say 60-70% of my portfolio is companies that grow the top line in the 10 to 20% range
Yeah, you're a
as
durable
opposed
growth guy. That's what I would describe you as.
yeah, I think that's the goal for most of my investments. But anyways, let me just go through a little bit more of my criteria. So typically what I care about most, more than just current revenue growth, because you can get like comps that are favorable or certain currency headwinds depending on the company you're looking at. Isn't just so I don't care, are they growing fast now, but can they grow the top line by 10%, 15% plus for more than 5 years? Because that's really, I think, where you get a lot of true mispricings is when people can't guess how long they will be able to grow at a sustainably high rate. So that's what I typically look for. And then the other thing, best case scenario for me is when you've got a company that you think can grow 15% plus for 5 years or whatever, and they're turning the corner to profitability. Because I feel
Yeah.
like I tend to see a lot of mispricings with growth stocks when people underestimate how much they can actually earn or how profitable
Or
they can be at
underestimate the
scale.
growth.
Yeah, or
Or underestimate the growth. I mean, I think I have a tough time looking at a lot of businesses and project unless it's a tiny company and project, "Oh, well, they're gonna go 20 to 30% for the next 5 years." That's very hard to do because that is abnormal unless you have a company like TSMC, as we talked about earlier, that just has a massive tailwind at its back and is a monopoly. But if you can get those 20 to 30% growers, that compound interest compared to 10 to 15% can add up very quickly over a 5 to 10-year period, and that's kind of why we wanted to do this exercise, take a look at, watch list stocks, our own portfolios, and see what companies we actually own that are growing revenue at over 20% per year. So, Ryan, I'll let you go first. What is your first number 1 favorite growth stock in your portfolio or watch list today?
yeah, I imagine this might be on your list as well. And Simon actually called it out in the chat. He's already guessed it. It's Remitly. I've talked
Yep.
about, yeah, I've talked about him a lot on this podcast. I think it makes up, let me check my portfolio right now. I believe this is, yeah, about 8.5% position, my second largest position.
I'm at 12. I got you beat. And
Really?
with the current drawdown, it used to be used to be 15 for me. But the current drawdown has not been too kind.
Yeah, exactly. So quick pitch on them. A digital remittance mobile app that it's fast, cheap, convenient, and like reliable for customers to send money across borders. And as the world has been continuously shifting more and more towards digital remittances instead of physical remittances, Remitly is capturing a lot of new customers, and those customers seem to stick around with Remitly. So they're in the right spot. They've built out a really nice user interface, user experience. They've got great brand notoriety, great marketing, just great tailwinds at their back, and they're trying to drive down costs for customers where possible. So trying to reduce the transfer fees for customers. And over the last 6 years, they have grown revenue by 56% annually. And right now, they're still growing revenues by more than 30% annually. Ad so this does check the plus more than 20% revenue growth category for me. It checks that box. But the other part I like is it's we just talked about this. It's just now turning the corner to profitability, and it seems like a lot of people are both underestimating how long they can sustain their growth rate and how profitable they can be. I think this could be easily a double digit operating margin business
Yeah.
at scale, probably 20% plus when we think out really long term. I mean, there's not a ton of like it's a high gross margin business. It's digital. It's not super costly to run other than tech talent for the most part and marketing. So I think they're in a really good position. That's the one I like the most. And then also convenient in this case is that it's cheap on a valuation basis if you think those estimates long term are right.
I know, fingers crossed. I like this one a lot too. I feel like, over a decade, it has 10 bagger potential, which gets me quite excited to own the stock. Let me go to my second one. I'm just going to take the one that Simon also stole from me. He pretty much predicted my whole list. It is the Real Brokerage. It's a company I just did a stock research report on. So if you go in our queue or on our Substack, you can look at the full stock research report on them. It's a comprehensive, I think probably about an hour long episode and maybe a 10 to 15 page report that you can read in maybe 15 minutes. It's a cloud-based brokerage. It's someone that is taking kind of the legacy brokerage model where you partner with real estate agents, but reducing fees, making it digital only, trimming costs, kind of a modern solution, digital tools. They're launching things like financial services or real estate agents. Essentially, it's your software and financial tool for a real estate agent or their team. And they're growing like a weed, taking market share. I mean, if for anyone that's listening, if you're someone that is getting, I don't want to, I'm not saying this disparagingly, like caught up in the open door management transition and you like that story, well, they're talking about a lot of things that sound like the Real Brokerage's model right now. So if you like open door, I'd take a look at the Real Brokerage because they've grown their revenue from under 10 million to 1.6 billion over the last 12 months. Last 12-month revenue 72%, 2024 revenue 80%, 2023 revenue over 80% again, so growing extremely quickly. I'm very uncertain on what the long-term like bottom line margins will be, but I'm taking a small position in this company. I think it's 3 to 4% of my portfolio today, which again is small for me. I would add over time. I'd add if the stock goes higher and the business is doing quite well. I think it's a good growth opportunity. It's one where I think revenue can grow at a very, very quick rate. Is it gonna decel a little bit on a percentage basis? Yes, but it's one I like, the long-term growth opportunity.
Yeah, that's one of those where when I think growth stock, I think something like that where it genuinely does have 10 bagger potential if things go really well for them. Whereas the downsides may be little higher than if you look at some of these mature businesses that we both own. So I think that's a good one. Definitely, definitely could be a great return if the business performs. I'm gonna skip to my second one here, or do we want to go snake draft?
Go ahead. Hopefully you're not gonna steal mine.
I think it's unlikely. I'm going with Grab Holdings. I did a full research episode on them a couple months back. So if you want to go find it, go ahead, just look up Grab or scroll through our podcast feed and you'll find it. But Grab Holdings is a true super app in Southeast Asia. They are the market leader in ride sharing, food delivery, grocery delivery, even in 8 different countries throughout Southeast Asia. And they also have sort of an emerging financial services component to the app.
You can say it, Ryan. Super app.
I
Super
said it.
app. It's a
Yeah, it is
dirty
a
word.
super
It's a
app.
dirt good, good. Yeah.
And we actually just had an interview. I'm not gonna say who, but a great investor that we both admire. We subscribe to his Substack. We just had an interview. We had him on the show. I think that episode will be coming out in the next couple weeks. And he lives in Singapore. And he mentioned, I asked him, like, what do you think of Grab? Because he said he listened to that episode, and he said anecdotally, everyone I know uses it. So it did seem
Dominates
to
the market.
have,
Yeah.
yeah, it did seem to have some real super app vibes, I guess. But it's a lot like an Uber and a DoorDash combined. And one of the great things about a business model like that, and you see it with Uber today, you even see it with DoorDash, is there is that embedded network effect in the business model where once you get to scale, it becomes a lot easier to grow at a high rate and at a low incremental cost. And I think Grab's in that position now. They've grown revenue at a 54% annual rate over the last 4 years, although it's come down a bit lately. So still growing above 20%, but uh, starting to see some operating leverage in there as well. So yeah, Grab is my second one. I got to double check the valuation. Not quite as cheap, I don't think, on forward basis as Remitly, but it's one I like.
All right, that's an interesting choice. Now, I'll take a little intermission here. Say Tyler in the comments enjoyed or says they enjoyed the Yelp podcast report. Says A+ for it. So kudos to Ryan. He's very happy with the research you did. If you're wondering where to find that, that is going to be the one right before this episode. If you're new to the podcast, it is a full stock research report in video and audio format. Ryan goes through the whole business model with Yelp, the potential opportunity and why he added it to his portfolio. So go check that one out. But let me get to my second choice. This is one I think Ryan could have on his list, but one we both like the business and I don't think own it yet. Although I could definitely see myself owning it. I actually checked before recording this. The stock is in a little bit of a drawdown. It is New Holdings, the parent company of New Bank, a very fast growing bank and dominant bank now in Brazil, but fast growing in Mexico and Colombia, going to expand into new markets shortly. The pitch is really it's I guess if people know SoFi, it's kind of like a SoFi for these Latin American markets. It's a digital only bank plus other solutions for personal finance. It's just simply better than the legacy players in Brazil or Mexico, which are significantly worse than the say legacy players you get in the United States. Like, if you look at Bank of America or Chase, they're serviceable options, but they just offer way worse interest rates, buggy solutions compared to with SoFi or an Ally or what have you. Nubank has maybe even a better product, and the competition is worse. So this is why they dominate. This is why they have over 100 million users. And I forgot to check the revenue growth, or I forgot to write it down, but I checked beforehand. It's definitely above 20%. I think it's 29%. So I think great business, keeps growing, really strong management team. Am I buying? I'm not sure, but it's close to the top of my watch list.
Yeah, net interest income is currently growing 22% year over year. I mean, for a bank, revenue is like kind of a tough
Well,
figure
they
to
have fees.
use.
They have a lot of fees. Hey, they have non-interest interest income.
If you use pure revenue as a standardized version, new would not qualify
Are you sure last quarter?
because you
Let's look.
you have
Maybe
to
I looked at the wrong
include
figure.
the provision for loan losses. And
Well, let's look at what I saw 29%.
I'm seeing
But
14.
all right, let's pull it
Either
up.
way,
All right.
either way, I agree. This was the number 3 on my list as well, and it's nothing like from what I can tell, there isn't anything crazy unique about the business model. It's just the classic innovator's dilemma. Like online bank versus a bunch of legacy branch banks. They've got a better app. They have lower costs, so they can offer higher savings rates. They can offer credit cards without fees, all the good stuff that you get from the disruptor. And they've done a really, I mean, the usage speaks for itself. Going from 3 million customers to 114 million in less than a decade, this is a viral app and one that should be very sticky with customers and earn more revenue from them over time. So, yeah, I think this is a clear winner. And whether or not they make it on the last quarter's revenue growth figures, it doesn't matter because when you go from 3
They
million
have.
customers,
I pulled it up. USD 29%, FX neutral 40%. So don't worry. I'm qualifying with this company to the
okay.
listeners.
Yeah, I was gonna say you we're splitting hairs. If it if they've gone from 3 million customers to 114 million in 7 years, I
It's a
call that a
growth
growth
stock.
stock. Okay, so that was my 3rd one. I
No, no,
have
what is your 3rd one?
that was, initially
Oh,
in
do
my
you have a
list.
4th? Do you have a sub?
Well, one of them honestly could be Taiwan Semiconductor, but we just talked about them. So I've got some
That's a fair
honorable
choice.
mentions here.
Interactive Brokers?
They would qualify too, which they just had great earnings, by the way. 2 for you, Monday.com.
Yeah.
Although admittedly, I don't know the competitive landscape as well there. Apparently, it's just like a better
Asana?
mousetrap essentially, where it's
Yeah.
become like a very, very good CRM, and all their customers rave about the product. And you see that in a lot of the attachment numbers, the revenue retention rates are really strong. But the other one I'm gonna take, I think instead, I'm gonna go with Adyen.
What a good
I
one.
I believe they still qualify, but this is one where I have never been able to get it at the right price that I'd like to get it at.
There's about 2
Although,
days where it was down after that weird guidance reaction.
yeah, there was a 50% drawdown or something like that, where maybe it wasn't 50%, but I should have taken a swing on it. But it's such a good, if you can really be the payments processor and be sort of that backbone, it's very tough to replace for businesses, especially online businesses. And they have the highest uh, acceptance rates, or I forget the term that's used in the payments landscape, but they're able to process successfully the most payments. Whereas sometimes if you get some of these other processors, you see them failing to have as much success and higher decline rates where maybe it shouldn't be happening, which is huge revenue lost for any sort of merchants.
I'm
And
gonna hey, I'm gonna let you have this one, but I just checked on fiscal last quarter decel 19%. This is in euros, and the euros appreciated, so I'm betting FX neutral. They're above 20%.
let me see
Uh,
what you're looking at here.
Total revenue percent change June 2025 quarter.
I'm seeing plus 19. We looking at the same data?
I said plus 19, yeah. That's under 20,
Oh,
right?
oh, I thought you said minus 19 for a second. All right. Well, I
Big
guess I
count.
was
I'll
wrong.
give it to you. I think FX neutral, they probably clear. I haven't looked at the press release, but
Yeah. All right. Well, I guess that's why it'll remain an honorable mention. I need to. I would probably need to do some more digging before I felt really compelled to add it. Like, I need a different stock price as well, but I might want to understand the business and the nuances between them and Stripe. But like, I'm familiar with Stripe. It is a phenomenal platform, and from what I've heard, Adyen is just as good, if not better. And it has such a high retention rate. As there might be logo churn because merchants go out of business, but if you have a great payments processor, I doubt you're going to switch.
yeah, I don't think you need to do any more research. You got it there. The forward EV to EBIT or EV to EBITDA, which actually I think translates fairly well to free cash flow for Adyen. It's only 24.
That
That's
is
according to fiscal.
that's
Now, EV could be do your own definition on that, but
yeah.
stock's getting a little cheaper.
Do you have any others, or we just hit our top 6? I think it's all of them.
I have my last one. I'll make it quick because we have other topics. It's the northern airports in Mexico. They're actually growing 24% year over year revenue, and I think it will accelerate once they get this new contract in there. So I'll leave it at that. Keep that one short. Monopoly business. I did a research report on them earlier this year. I think a fantastic asset, and they're getting a new contract coming in that should lead to a step change in revenue growth in 2026. So yeah,
I
and
did
I
not realize they were growing that fast.
part of it is their do you remember the construction revenues?
Yeah.
So if you exclude construction revenues, which is kind of a loophole since that's like net zero margin, it's just the one that they get reimbursed for, I believe, from the government. I can't remember exactly how it goes, but excluding that, still 17%. So good, but the loophole comes from that construction boost.
So we broke our rules a couple times, but that's all right.
Well, hey, that mine's not breaking the rules. That's the revenue.
Yeah, I guess that's true. All right. Quick stat for you. We're shifting gears here. Charles Schwab, get this. Cash as a percentage of client assets. So basically how much cash the Schwab customers are holding on in their accounts is the lowest it's been since the great financial crisis.
And it's lower than the peak of the SPAC bubble. I'm looking at your chart
Yeah.
here, which maybe you can share, or else people can just look it up themselves. It's a nice, I think, a custom one. Did you make it on fiscal?
No, this is a
Uh,
KPI.
this one they do. Yeah. So basically, for anyone that wants to know, it's just the cash divided by their total client assets. So that just means like stocks people own, all the customer, not necessarily equity, but the assets. It was 11% at the bottom in, what would that be, June 2021. So it's right around at the peak of the SPAC meme electric vehicle COVID bubble. Today, sorry to spoil it for you, Ryan, I know this is your stat, 9%.
Isn't
That's
that
low.
markets are near all-time highs, and this is like the lowest dry powder that's been on the sidelines from Schwab, which is probably a decent barometer for US investors generally because they
Yeah,
have
what is Robinhood,
35 million
-8?
accounts. Yeah,
Ro
yeah, probably. There's no dry powder. I mean, it feels aggressive. This to me, of all the bubble talk that we do and all the stuff we say about valuations hitting peaks and every other indicator that you see, having just 9% cash on the sidelines, the lowest since the GFC, that to me is a real indicator of maybe it's time to get a little more conservative with my portfolio.
I agree. Keep a little cash position. I guess I've been doing a little shorting, um, on some energy companies, quote, unquote, "energy companies." They're doing a lot of theoretical energy stuff, but that is a good data point. I think it lines up with what people are feeling, and that's always good where you go, "Alright, I feel like market's getting a little frothy. I don't wanna go on margin or anything like that. I don't wanna do anything extreme in a time when over the next 3 to 4 years, we could see terrible market returns. Not saying they're guaranteed to happen, but that is something that could happen." Yeah, it's a good data point.
Okay. Do we want to talk Interactive Brokers earnings?
Let's do it. Did you see their profit margin?
It is the most insane operating margin. I think it's the highest operating margin I've ever seen, actually.
Outside of some, like, water rights licensing company in Texas or something like that, for an operating business, it's definitely the highest.
79% operating margins this quarter.
Yep,
It's outra
and
and it's expanding. How is it expanding at this level
it's
already?
scale. It's scale and automation. Let's look at what the stock's doing after hours. It is down. I don't know what's gonna react to tomorrow when people are listening to this, but what I will say is that this is a company I have high confidence in their long-term competitive advantage. I feel like I bought at a right price in the spring today. The stock is a bit expensive, especially when you consider the potential cyclicality of earnings when they're tied to the potential bubble forming. But there are a few things I just look at every quarter to just track how the business is doing. And I honestly just go to sleep and I don't care what happens. They're going to the stock will probably go down 30% if the market craters. That's fine. I'm just going to keep holding through the long term. And as they add more customers, things will be good. So, what I look at is total customer accounts grew 32% to 4.1 million. Customer equity increased 40% to $758 billion. Commission revenue, trading revenue on stocks and options both grew. Net interest income increased 21% to $967 million. That may see a headwind if interest rates fall, but there's also growth in margin lending. There's also growth in total accounts. So even if there's a headwind on the net interest income or the net interest margin, the spread they can earn, or so, however you want to define it, if they grow their customer accounts, that number should grow the long term as well. And then, as Ryan mentioned, pre-tax profit margin for the quarter was 79%. That's not adjusted, so the reported and adjusted were that one. Last quarter, a year ago, it was 67%, but they had, I think, some one-time fees of $88 million, according to some legal matters. Yeah, it's a fantastic business. I think it's going to generate a lot of cash over the long term. Conservative balance sheet. That's it. That's it.
They have for a brokerage platform that has been operating for, what, 40 years? They have 20x'd their total accounts since 2012. It's like like a growth, just a massive growth phase out of nowhere. They've gone from like 200,000 accounts to more than 4 million. It's it's one of the most under discussed growth stories, I'd argue, of the last decade. It surprises me that most people don't talk about this as one of those wonderful compounders.
My friend said that since they advertise on the show, which I will say free advertisement, I do use the platform. You're gonna hear the ad on this episode. I would definitely consider switching. My friend says the fact that we talk about it on the show, that it's an advertiser, that I'm a shareholder, and that I use the platform, it's too, self-reinforcing, and, but
Could be.
I
A little
yeah,
bias.
technically, yes, I am talking my own book when it's an advertiser, but I'm one of 4.1 million clients and a small one at that. So, am I impacting the business? No, but I'd
Yeah.
like to see them grow, and it's a great platform. I'd like to see people to switch to it.
And even if, like, let's say the market tanked, dropped 30%, whatever, and you had a recession, maybe they'll generate 50% operating margins. Maybe the non-interest income portion would come down, like the commissions and fees. Like, you'd
Yeah,
see less
and
trading most likely,
it's a
but
and it's a buying opportunity.
yeah.
This is one where if there's a recession, if there's a bear market, it's just a buying opportunity for me. If as long as those KPIs I mentioned, customer accounts, client equity, um, and I guess margin is more or less determined, as Ryan mentioned, by the market cycle a bit. But if they keep growing customer accounts, I'm totally fine.
Yeah, all right, do we wanna talk gold and silver?
We
Not
had
a
people ask
typical
about this.
Yeah, not our
Um,
typical conversation, but
we're not metals guys, no, but people like to invest in these. I'd say nothing wrong with it, and as long as it's not your entire portfolio, and they've done quite well year to date. It has been a good year, a good 2 to 3 years if you've owned gold and silver, and a really good last few months. Gold is up to $4,300 an ounce. It's up 60% in the last 12 months to an all-time high. Silver is up to $53. This is as of our recording on October 16th, and it has a very similar looking chart. People ask why. Maybe it's fear out there of inflation acceleration. Maybe there's the dollar depreciation in there. I think that's probably part of it. I also think this is a type of market, gold and silver, that there is a lot of momentum and reflexivity where people like gold, they want to get in on the trade, and it's something that you can ask anyone, oh, have you seen the price of gold? Oh, I want to get on that. It's up 50% in the last year. And this is why, if you look historically, I hate to be a Debbie Downer, but precious metals have extremely quick, historically, blow off tops and then they collapse. I'm not saying that's happening tomorrow, but this is how I would look at it. It that maybe helps with the base rate of the situation. That's a weird way to say it. That was a stupid way to say that. But if you're someone, I think this is maybe the smart way to look about gold. I know there's a guy out there that I think we've had on the show before. Someone is an honest account online, Value Stock Geek. People have probably seen him. He has a portfolio where it's like 25% gold, 25% stocks, 25% some other things. And when you have it like that, set at a percent allocation of your portfolio, that can be helpful because in a situation like this, you're going to be forced to trim back and then add to some other stuff. So, yeah, that's kind of how I look at it.
so question for you, because gold, I don't think you've ever invested in gold from what I
Never
know from you.
have. I don't think it's for me.
Would you rather, if you were forced to put money in one or the other, would you rather own crypto, let's say Bitcoin, or gold?
Oh god. I think, gold, because I don't think it could 0. But right now, that's tough because it just went up like 100% in the last 12 months.
Yeah, yeah, that's a good point. Do most people buy it through like an ETF structure, or are they buying
Yeah.
futures and would theoretically have like an actual claim to physical gold?
I think it's both. So, someone like us, I think, would just buy an ETF, something like that. I'm sure there's one out there with a very, very cheap fee, but there are a lot of people that like physical. And you can go and sell it at places that have some decently high fees, but there are a lot of people that hold physical gold and silver, and I know some of them.
Yeah, this is definitely one of those asset classes where price drives further price,
Price
where
drives narrative, which drives price, which drives narrative, which
yeah,
drives price.
exactly. Yeah, it's kind of an endless loop. I mean, that's the reflexivity portion of it. The And you see people talk about it so much, and it's always in the news, always in the headlines. People always talk about the price of gold. "Oh, gold is
Advertisements
up
on CNBC
100%."
and Fox News, yeah.
Yeah, and it's like, that alone and part of it is because it's almost like meme stocks in a way. If gold had to report earnings, then it might have to you know what I mean? Like, it might have to
Yeah.
follow fundamentals. It's
Well,
same with
that's what makes
crypto.
it great. There's never earnings.
The only thing to analyze, aside from macroeconomic conditions, which is too big it's too big of a topic, I think, to be like if you're a gold investor, being the person that is constantly predicting the macro environment as your price for gold seems like way too that's a Herculean challenge, in my
Yeah, it's like
opinion.
astrology. I've never seen anyone be accurate with that, but if you want it to be a part of your portfolio, I have nothing wrong with that. Just don't make it 100% of your portfolio. Would you agree?
And 100% of your personality.
Yeah,
Don't
that's fair.
don't become the person that brings it up at the dinner table, but
Yeah, that's fair, that's fair. That's good for any topics. I do that with Mexican airports. No.
have you guys heard about the monopoly in Monterey that they've got
Have you
going?
heard any news on the concession, what their rate's gonna be? Yeah, that's a great topic. Alright, here's something that I think is maybe more interesting for some of our listeners, probably more interesting to Ryan. It is the announcement from JP Morgan that they are going to be doing $10 billion in direct investments into US strategic sectors and are going to be doing, which I assume is facilitating, financing, helping with deals, IPOs, and other investments is $1.5 trillion in total help, which as a bank, that's a large number, but in reality, it's not that large of a number if they're just helping other people invest it. They're going to be doing $1.5 trillion in facilitation and financing for strategic industries. And this is a 10-year plan. I'm going to list off, well, here's the broad categories: supply chain and advanced manufacturing, defense and aerospace, energy independence and resilience, and frontier and strategic technologies. A lot of listeners wanted us to talk about this. I'm going to list off the 27 subcategories, and I'm going to go through one, and you just tell me one that you're actually interested in, and you think when looking at like a potential investment, you would have any interest in saying, all right, JP Morgan, the government, just the US economy in general is investing in this category. And I think I could maybe find some stocks that are interesting.
Just to
First,
just to
or
be
go ahead.
clear, they're committing to 1.5 trillion in total facili
Facilitation.
facilitation
That's
and
just,
financing. That's
it's
just
like doing
business
an
as usual.
IPO. I know, I know.
That's what banks do.
They are committing. They actually originally, according to their press release, had committed $1.1 trillion over the next 10 years. That was their goal, and now they're upping their goal to $1.5 trillion. So it's fair. It's like, okay, this is our priority over the next 10 years. This is our goal to hit this number of financing, and they're going to do $10 billion in direct investments.
Yeah, the
So
10 billion, I say whatever, that's kind of a drop in the bucket for them, but
we're not thinking about JP Morgan. Let's think about the industries that they could invest in. Here, I'm gonna go through the list. Tell me anything
okay.
you might be interested in. Advanced bulk materials, nanomaterials, microelectronics, critical minerals mining and processing. That's what people have been talking about a bunch with stocks like MP Materials, the rare earth metals that have been in the news lately. Pharmaceuticals, precursors, advanced manufacturing, mission critical real estate, shipbuilding, autonomous mobile robots. And then if we go into defense and aerospace, we have command and control tech, critical components, spacecraft, space launch, unmanned systems, munitions, missiles, and hypersonics. 6G. Hey, we graduated from 5G. Secure communications, mesh networks, and then energy independence. We have nuclear, grid resilience, distributed energy, battery storage, solar, and then strategic technologies, cybersecurity, quantum computing, artificial intelligence, edge computing, and sensor hardware. Anything interest you here, Ryan? I think one, this is going to help Kraken Robotics. I should say that. A company I did I think it was the last podcast I did on. Fascinating company that we did a show on, sometime this year. Anything here catch your eye?
No.
You
Honestly,
hate
no.
tech. You hate deep tech, so I was
Well,
it was
yeah.
doubtful.
So it's I mean, on the one hand, it's like, yeah, it makes all the sense in the world for one of the leading banks globally and in the US to be helping facilitate finance, invest in these categories because they seem critical for American security. Most of them, I should say. But I'm not investing in any companies in any of these categories solely on the principle that they'll have JP Morgan's help.
Yeah, or the government's help. I mean, a lot of listeners have asked about this. It's been a big theme of like, oh, what's the government gonna back next? Which that's not how you run a nice free market economy, but that's a different discussion.
Yeah.
I think one thing for me is defense and aerospace. Not that a lot of these stocks are cheap right now, but anything connected to the supply chain or is making stuff, again, Kraken Robotics is an example for modern defense solutions, autonomous stuff, military or commercial. Waymo as an example, but that's under Alphabet. Shipbuilding and then spacecraft space launch. I think that is a multi-decade tailwind. There's a lot of potential there. You can look at probably a lot of niche contractors out there, not just the Lockheed Martins of the world, and there's going to be financing for these companies available. And then you can maybe find some interesting opportunities, such as, maybe not Kraken Robotics today, but a couple of years ago, Kraken Robotics is at 50 cents. Now it's at almost a 10 bagger since then. Or yeah, it is a 10, maybe very, very close to a 10 bagger since then. There could be some opportunities there. But if we look at quantum, energy, nuclear, AI, I don't know if there's much of a we
AI, do they need your help?
I know it's already there. There's already a lot of investment there. Where are you gonna find any edge? Stuff
NVIDIA
that maybe
needs you now. They need your financing. It's, uh, I think of everything in here, the areas that I'd maybe feel the most inclined to invest are, mm, like, the defense industry is nice because it's easy to analyze, and a lot of the contracts are very predictable, and the businesses are run pretty well, and they're fairly shareholder friendly. The the rest of these feel pretty outside my circle of competence. I've always wanted to be an investor in shipbuilders and, like, transportation and
why?
logistics companies. I don't know why. I've just always thought that the massive freight haulers, shippers have a moat. I've just kind of always felt like people are not dying to get a massive ship like that and move it across the world. Like,
Well,
there's
they're all in
barriers to
China now,
entry.
so
Yeah.
yeah.
There's capital intensity, which is quite the big barrier to entry. So I've always wanted to do that, but it feels like a very unpredictable industry. And it seems like there's a new geopolitical crisis that hurts these companies every 6 months or something like that. So,
Yeah.
yeah,
I think right now this defense tech stuff is a little bit trendy, but if we go through a pullback, maybe that's where you can find some opportunities. Who knows? All right, you wanna look at related to this, another energy bubble stock I potentially found?
sure. Let's do it. Bubble watch of the week. What do you have?
All right, this is a air quotes energy stock. They seem to multiply like wildfire. They're coming out of the woodwork. It's a company called Fermi. Just went public. Ticker's FRMI. Actually run or chaired by. There's a relationship to Rick Perry, who was the old energy secretary of the United States. Market cap 17 billion. This is what they say they do. Fermi America is pioneering the development of the next generation private grids that deliver highly redundant power at gigawatt scale, required to create next generation artificial intelligence. Now, that sounds great, but can you guess how much revenue they have?
Either a minuscule amount or zero.
They've never
Zero.
generated any revenue.
Yeah, sometimes you'll see like them record like $1,000 in revenue from some like
Oh,
contract
I
that
mean, yeah, or they do fake revenue. Yeah.
it is amazing. Like whoever sold, I assume the founder, once the lockup's over, is going to sell shares of this thing. People are getting, it reminds me of 2020. This is generational wealth. Like they can earn generational wealth from these
From the sellout,
events,
selling it.
from
Yeah.
this good, well, what if you're willing to destroy your reputation and sell out, like good for you, I guess. I mean,
If
but
you
it
can
just,
sleep at night.
it, this is the stuff that reminds me of the 2021, 2022 SPAC bubble. I, on the one hand, I get frustrated and think it's not fair that these people are building generational wealth without building value for anyone in society. But on the other side of things, if it introduces more private companies to public markets and that's what it takes, and we have to go through these like 2-year bubble periods where all the crappy companies come public too, but you find a few more gems, I'm okay with that.
Or just short into the lockup period.
Yeah, that too.
Alright, before we before we get out of here, people want us to talk Ferrari. They mentioned it 2 weeks in a row, so let me just go through the numbers. I know we've been kinda interested in them. Stocks in a 24% drawdown. They had their capital markets day. People were asking, "Well, why?" They're guiding for 5% revenue growth. Unit volume is not gonna grow. Let me just go through what they said quick, um, just before we get out of here. So active clients grew 20% since 2022. They're guiding for $2.75 billion in EBIT by 2030. The market cap after this drawdown is 75 billion euros, so that is 27 times 2030 EBIT. People were very confused that they were guiding for just 5% annual revenue growth, but I think that's because they are afraid of growing unit volume too much because they want to remain a true luxury company. I'll close things out here, Ryan. What price would you buy Ferrari, and how do you compare it to Hermes, which is trading at 33 times trailing EBIT? Again, Ferrari's trading at 27 times 2030 EBIT.
Yeah, I still don't like Ferrari here. Look, the Ferrari business model is really cool and it's very unique and it's very exclusive. And the fact that they sell cars on average for 450 grand a piece is great. 52% gross margins in the auto industry is unheard of.
It's a luxury
But
business.
there's a cap to growth. There's a cap to growth for a couple of reasons. One, they just can't grow volume. They've grown volume at I think 5% a year over the last 5 to 7 years. They can't keep doing that. There aren't enough billionaires in the world, and the more that you do grow volume, the more it hurts the value of the people that are a part of that Ferrari club. So it eliminates some of the exclusivity. So I would guess that you're gonna, if it's 5% annual revenue growth, it's probably all gonna come from pricing.
And that's good. That's good for
It is
durability of
good.
the business over the long term.
It's good for margins too.
Yeah.
But there's just a cap to growth with a business like this.
Yep.
And these items are, even though it's like, yeah, they've got pricing power, like an Hermes bag is 10 grand, 15 grand, 20 grand. This is a $500,000 car. Some of these are $2 million cars. It's not something, I think Hermes can grow volume and pricing at the same time. I don't know if you can continue to see that for Ferrari.
No, I agree. And I'd rather buy Hermes at 33 times trailing EBIT. I think it's growing faster and it probably can grow faster. All right. That's it. We're going long. We got some great interviews coming up on the show. We're always going to have the Power Hour. We're actually going to do a special AMA Power Hour pre-recorded. I'm going to figure out the best way to get the questions for that, but those are going to be more hopefully thoughtful questions from listeners, and we'll do in-depth, thoughtful responses that we prepare some notes and research for, as opposed to the off-the-cuff stuff during the Power Hour. Yeah, interviews with stuff on Fairfax India. We're going to do stuff on actually a new holdings update from someone. We're going to be doing something on the Argentinian economy and maybe stuff around what's going on there and some opportunities in Latin America and lots of other fun stuff. So follow the show, give us a review, 5 stars, Spotify or Apple, and let's hit the disclosure and get out of here. We're not financial advisors. Anything we say on the show is not formal advice or recommendation. Ryan, I, or any podcast guest may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you everyone for tuning in, and we'll see you next week.